Every investor asks the same question. Should I buy gold? It's a question that echoes through financial forums, hushed conversations at family gatherings, and late-night research sessions. Some gurus swear it's a relic of the past, a shiny, useless rock. Others, with equal fervor, claim it's the only true safe haven when the world catches fire. The sheer volume of conflicting advice makes your head spin. You've probably heard it all. Gold is a hedge against inflation. Gold is a barbarous relic, yields nothing. Buy gold, the dollar is doomed. Gold is for doomsayers. It's enough to make anyone throw their hands up in frustration. How can something so simple trigger such passionate, wildly different opinions? Where does the truth really lie amidst all this noise? And more importantly, what does any of this mean for your money, your future, your peace of mind? We're about to cut through the confusion, peel back the layers of dogma, and get to the core of what gold truly represents in a modern portfolio, starting with the very first, most fundamental disagreement. The portfolio question no one agrees on. Imagine stepping into a room filled with the world's most brilliant financial minds. You pose a single question. Should a portfolio include gold? The silence would be deafening for a moment, then an immediate, furious debate would erupt. On one side, a chorus of voices would chant about diversification, inflation hedging, and historical precedent. They'd point to moments of crisis when paper assets crumbled, but gold held its luster. They'd talk about its intrinsic value, its timeless appeal, its role as the ultimate store of wealth when all else fails. But then the other side would roar back. They'd scoff at its lack of yield, its inability to generate income, its volatility, and its status as a fear asset. They'd argue that in a world of innovation and economic growth, holding a shiny metal that just sits there is akin to leaving money on the table. They'd push for productive assets, for companies that grow, for investments that pay dividends. Who's right? The truth is, there's no single, universally accepted answer. The very first hurdle in understanding gold's role is confronting this fundamental split. We need to dissect what gold claims to do before we can even begin to understand its place. So, beyond the heated debates, what does gold actually do in a portfolio? Forget the emotional arguments for a moment. Let's look at its practical functions. Historically, gold has served as a safe haven asset. When markets plunge, when geopolitical tensions flare, when inflation fears grip the economy, investors often flock to gold. It's perceived as a store of value, something tangible that doesn't disappear with a click of a mouse or a government printing press. Think of it as an insurance policy that you hope you never need to cash in. It also acts as an inflation hedge, or at least that's its reputation. When the cost of living skyrockets and your dollar buys less, the thinking goes that gold retains its purchasing power. It's a protection against the erosion of fiat currencies. Another key function is diversification. Gold often moves independently of stocks and bonds, meaning it can help smooth out portfolio returns during turbulent times. It adds a layer of uncorrelated asset to your mix. But these are its claims. The effectiveness of these functions often depends on the specific economic climate, which brings us to the biggest factor you need to consider: your personal financial goals. Before you even think about buying a single ounce of gold, you need to look inward. What are your financial goals? This isn't a rhetorical question. This is the bedrock upon which every investment decision, including gold, must be built. Are you saving for a down payment on a house in 2 years? Are you planning for retirement 30 years from now? Are you seeking aggressive growth, or are you prioritizing capital preservation above all else? Your timeline, your savings targets, and your desired lifestyle in the future dictate everything. Someone with a short-term savings goal might find gold's volatility unsettling and its lack of income generation counterproductive. Their focus needs to be on stability and accessibility. Conversely, a long-term investor, perhaps one concerned about systemic financial instability decades down the line, might see gold as a prudent long-term hedge. If your goal is aggressive growth, gold might feel like a drag on your returns. If your goal is to sleep soundly during a global crisis, it might feel like a warm blanket. Your financial goals are the North Star guiding your investment ship, and they will profoundly influence your perspective on gold, as will your individual risk tolerance, which changes everything. Your personal risk tolerance is not just some questionnaire you fill out once. It's a deeply ingrained part of your financial DNA, often shaped by past experiences, your temperament, and even your current life circumstances. Some people can watch their portfolio drop 30% in a week and barely blink, viewing it as a buying opportunity. Others would be paralyzed with anxiety, checking their accounts every 5 minutes, losing sleep, and making rash decisions. Where do you fall on this spectrum? If volatility makes your stomach churn, if the thought of losing even a fraction of your capital keeps you up at night, then the roller coaster ride of purely growth-oriented assets might be too much. For someone with a low risk tolerance, gold, with its reputation for stability during crises, might offer a psychological comfort that outweighs its lack of income. It's not just about financial returns. It's about emotional returns, about feeling secure. But if you thrive on risk, chasing aggressive returns, then gold might seem like a dead weight. Your comfort with uncertainty will dictate how much, if any, gold makes sense for your portfolio, especially when we look at how it performed in history's worst moments. History offers a brutal, unfiltered look at how assets perform under extreme duress. When the world teeters on the brink, when economies crumble, when wars erupt, or pandemics sweep the globe, where does money flow? For centuries, gold has been the destination of last resort. Think about the Great Depression, when banks failed and paper money lost trust. Gold, though subject to government confiscation at one point, largely held its value. Consider the inflationary spirals of the 1970s, where gold prices soared as the dollar's purchasing power eroded. In the 2008 financial crisis, while stocks plummeted and real estate markets collapsed, gold saw a significant surge in demand, proving its mettle as a safe haven. During times of geopolitical uncertainty, like the dot-com bubble burst or the early days of the COVID-19 pandemic, investors frequently sought refuge in gold, pushing its price higher. These are the moments when gold proponents shine, pointing to its undeniable track record as a crisis hedge. It's in these moments of systemic shock that gold often demonstrates its distinct, non-correlated behavior. But while it performs brilliantly in crises, the question then becomes, how much of this insurance policy do you really need? How much is too much? This is where the rubber meets the road. If gold is an insurance policy, how much coverage do you really need? Do you insure your house for its full value or just enough to rebuild it? The same thinking applies to gold. Holding too little might mean you miss out on its protective qualities during a downturn. Holding too much, however, can act as a significant drag on your returns during periods of economic stability and growth. Remember, gold typically doesn't pay dividends, nor does it inherently grow like a business. Financial advisors often talk about opportunity cost, the returns you miss out on by choosing one investment over another. If you have 30% of your portfolio in gold, that's 30% that isn't invested in stocks that could be compounding aggressively, or in income-generating bonds. For most investors, a small allocation, perhaps 5% to 10%, is often cited as a prudent insurance policy. But this isn't a hard and fast rule. The right amount is deeply personal and depends heavily on your unique circumstances, risk profile, and market outlook. This leads us to consider what the experts recommend through various frameworks and model allocations. Financial experts and large institutions don't just guess when it comes to portfolio allocation. They use sophisticated frameworks and historical data to construct model portfolios. You'll often see something called the permanent portfolio, designed by Harry Brown, which famously allocates 25% to gold, alongside stocks, bonds, and cash. This framework is built on the idea that no matter what the economic climate, inflation, deflation, prosperity, or recession, at least one asset class will perform well, providing stability. It's a very conservative, risk-averse approach. Then there are more mainstream allocations, where gold might be a smaller, tactical holding. Some advisors suggest a barbell strategy, putting most assets in very safe investments, like cash and some gold, and a small portion in very aggressive ones, ignoring the middle ground. Others integrate gold as part of a broader commodities basket, seeking diversification across raw materials. What these frameworks highlight is that gold isn't designed for aggressive growth. It's for stability, for hedging certain risks. They provide a starting point, but these models are generic. To truly tailor your approach, you must consider economy-specific adjustments. The global economy is a dynamic, ever-shifting beast. What works in one economic environment might be catastrophic in another. Therefore, any decision about gold needs to consider the current economic landscape. Are we in a period of high inflation, or is deflation a bigger concern? Is interest rate policy tightening or loosening? Are central banks printing money like there's no tomorrow, or are they reining it in? These factors fundamentally alter gold's attractiveness. When inflation is roaring and central banks are being dovish, gold tends to perform well as a hedge against currency debasement. When real interest rates minus inflation, are low or negative, gold, which offers no yield, becomes more appealing compared to bonds that offer meager returns. Conversely, in a strong economic environment with rising real interest rates and strong stock market performance, gold often lags. It's crucial to understand these macro trends. Blindly buying gold without considering the economic winds is like setting sail without checking the forecast. These broad strokes help, but ultimately, you need to build your personal gold rule. So pulling all these threads together, how do you build your personal gold rule? It starts with honest self-reflection about your financial goals, your risk tolerance, and your time horizon. Then consider the current economic climate and your outlook. Are you genuinely concerned about inflation over the next decade? Do you foresee systemic risks that traditional assets might not weather? If so, a higher allocation to gold might be warranted. If your primary focus is aggressive growth and you believe in the long-term upward trajectory of the stock market, then a minimal gold allocation, or even none, might be suitable. Your rule isn't about following a guru. It's about aligning gold's specific protective qualities with your specific needs. It's about designing a portfolio that allows you to pursue your goals while also providing the emotional comfort you need to stay the course. Ultimately, your personal gold rule will boil down to one final, critical check. Can you sleep with it? After all the analysis, all the historical data, all the expert opinions, there's one final, deeply personal question you must ask yourself. Can you sleep with this decision? Investing is not just about numbers on a screen. It's about peace of mind. If your gold allocation or lack thereof is causing you constant worry, leading to sleepless nights or prompting impulsive sales during market corrections, then it's the wrong allocation for you, no matter what any expert model suggests. Your portfolio should feel like a sturdy ship carrying you towards your financial destination, not a leaky raft that leaves you constantly bailing water. If holding gold makes you feel more secure, more diversified, and less anxious about potential market collapses, then it has a place. If it feels like a dead weight, or simply a trend you're forced to follow, then it doesn't. The ultimate measure of a successful investment strategy is not just its returns, but its ability to align with your psychological well-being. Getting this right means you can focus on what truly matters. Make sure to subscribe for more gold videos and hit that notification bell so you never miss a new video. We'll see you in the next one.